Have you ever peered behind the curtain of a tech giant and wondered what it truly takes for a company that's already a household name to not just evolve, but to fundamentally reinvent itself?
hmm
To pivot from being, a leader in payments to aspiring to be nothing less than a global commerce powerhouse, actively shaping how we all buy and sell.
Yeah, it's a massive undertaking.
It really is. It's fraught with both incredible opportunity and significant risk, and it's precisely what we're diving into today.
Indeed. What we're witnessing with companies like PayPal isn't merely about incremental product updates. It's a deep-seated strategic reimagining of their core identity and their role in a market that's changing at, well, an accelerating pace.
Right.
This kind of transformation demands not just a bold vision, but precise strategic execution, and perhaps most importantly, an agile ability to adapt to a rapidly evolving landscape of consumer expectations and merchant needs.
Absolutely. And that's why today we're taking a deep, deep dive into PayPal's second quarter 2025 earnings and the truly ambitious strategy they're actively executing. We've got a formidable stack of fascinating sources that lay all this out for us, including their Q2 earnings call transcript, the presentation slides, the official earnings release.
And even an earlier market newsletter that gives some really crucial pre-Q2 context from just a few months back.
Mhm.
It helps frame things.
Exactly.
So our mission for this deep dive really is to cut through the corporate jargon, bypass the superficial headlines, and pull out the most profound nuggets of knowledge from these sources. We'll highlight the surprising facts, explore the strategic implications, and ultimately help you, our listener, understand not just what PayPal announced, but why it matters for the future of how we all shop, pay, and, well, interact with money.
Get ready for some genuine aha moments because we're going beyond the surface to truly uncover what's driving this company's profound transformation. Let's unpack this with a critical eye. So let's kick things off with the headline numbers for Q2 2025. And what immediately jumps out is PayPal just delivered its sixth consecutive quarter of profitable growth.
Yeah, that's the key phrase.
This isn't a fluke, it's a consistent trend, and it signals a deliberate shift in their operational philosophy, doesn't it?
That's right. The term profitable growth is absolutely key here, and it's a critical distinction for a company of PayPal's scale. For years, the narrative often focused on sheer volume, total payment volume, or TPV, which we'll definitely get into.
Right, just the raw numbers.
Exactly. But the focus has clearly sharpened towards efficiency and the quality of those transactions. What's particularly telling is their transaction margin dollars, or TMR, excluding interest on customer balances.
Okay.
That's an 8% year-over-year increase. Now, that's a significant acceleration, especially when you compare it to the more modest growth rates we've seen over the past 3 years. It directly signals effective cost management and a move towards more lucrative, higher quality transactions.
So it's a shift from simply growing big to growing smart. And it's not just the margin dollars, is it?
No, not at all. Their non-GAAP operating income grew a robust 13%, with non-GAAP EPS up an impressive 18% year-over-year, hitting $1.40 per share.
Yeah.
And total payment volume, TPV, that total dollar value of payments processed, still huge, nearly $444 billion. That's a 6% increase, or 5% on a currency-neutral basis. So they're showing that this focus on profit doesn't mean sacrificing volume entirely.
Right, they're managing both.
And total revenue also maintained a healthy trajectory at $8.288 billion, up 5% currency neutral. Now, let's quickly touch on free cash flow, FCF, for Q2.
Okay.
It came in at $692 million, with adjusted FCF at $656 million. Now, it's important to note this was negatively impacted by what they call working capital timing shifts.
Okay, what does that mean in simple terms, like a temporary blip?
Pretty much. Think of it like a temporary short-term fluctuation in cash flow, maybe a delay in a large invoice payment to a supplier or a customer taking a bit longer to pay. It's a timing thing,
Gotcha.
not a fundamental problem with the company's underlying earnings power. And these shifts are explicitly expected to reverse in the second half of the year, so it's not seen as a long-term concern for their financial health.
Okay, that context is helpful. So if we connect this to the bigger picture, it sounds like PayPal is really executing on the predictions we saw earlier in the year. I remember the Money Machine newsletter from back in March 2025.
Right, that piece.
It explicitly highlighted PayPal's robust Q4 2024 results and their massive $15 billion stock repurchase program, even called it a game changer. Now here, in Q2 2025, we're seeing those earlier predictions for strength and capital returns actually materializing in tangible financial results. That newsletter noted a remarkable 171% jump in free cash flow back then.
Which was huge, yeah.
Definitely set a very high bar. But these Q2 figures show a strong continued trajectory for the company, even with that temporary FCF timing impact you mentioned.
Absolutely. That earlier context is crucial because it showed the market was already beginning to see the green shoots of this transformation. What's unfolding now is the validation of that early optimism. It suggests their strategic decisions are indeed translating into improved financial performance. These numbers are impressive, but they're merely the surface. Right? The real story lies in the underlying strategy driving this financial momentum.
And what a strategy it is. As their CEO, Alex Chris, emphasized, PayPal's laser focus is on transforming from being just a payments company, something we all, understand and use.
Yeah, the button on the website.
Exactly. Into what he calls a dynamic commerce platform. This isn't just a slight pivot. It feels like a fundamental reimagining of their entire business.
This is definitely more than a rebranding exercise. It's a profound declaration of intent. It signifies moving beyond merely facilitating transactions to actively shaping the entire shopping experience.
The whole journey.
The whole journey. Think about it. Anticipating customer needs, whether you're buying online, in a physical store, or even through emerging AI agents that might do your shopping for you down the line. Alex Chris has a bold thesis that fintech is still in its infancy. He genuinely believes the next 5 years will see more change in shopping habits and capabilities than the last 2 decades combined.
Wow, that's a big statement.
It is. This isn't just about capturing market share. It's about defining the future of commerce itself.
That's a truly ambitious statement, and it implies a massive undertaking. When you hear dynamic commerce platform, what does that truly suggest about the scale of their ambition? Because it sounds like deep integration, hyper-personalization, being present at literally every single touch point.
That's it.
But what are the biggest obstacles PayPal faces in truly becoming this? It can't be easy.
No, you've hit on the core challenge and opportunity. It requires significant investment in cutting-edge technologies, a willingness to evolve beyond their traditional payment processing routes, and a proactive approach to anticipating consumer and merchant behavioral shifts.
Right.
Now, PayPal's unique advantage, as Chris frequently highlights, is its unmatched scale and trusted brands, connecting hundreds of millions of consumers and merchants. He actually said, and I quote, "As the largest two-sided open platform in the world, we have the unique advantage of connecting hundreds of millions of consumers and merchants of every size to unlock entirely new, deeply personalized shopping experiences."
That scale is definitely a unique asset.
Huge. But the biggest obstacles, I'd say regulatory fragmentation across global markets is one, fierce competition from both incumbent banks and, those agile fintech startups nipping at their heels.
Sure.
And just the immense technical complexity of integrating all these disparate systems while maintaining a completely seamless user experience. Scale is an advantage, but it can also bring inertia, right? Making those changes quickly is tough.
That scale is certainly powerful, but yeah, it's a delicate balance to manage. A key part of this grand vision beyond just growth involves returning value to those who believe in PayPal's journey.
Yeah.
And they are certainly putting their money where their mouth is when it comes to commitment to shareholders.
Absolutely. The board approved a substantial $15 billion stock repurchase program. That's a clear sign of management's confidence and commitment.
$15 billion.
Yeah. And in Q2 2025 alone, PayPal returned $1.5 billion to stockholders by repurchasing approximately 22 million shares.
Just in Q2.
It's in Q2. Over the trailing 12 months, that figure rises to $6 billion, with about 84 million shares repurchased. And looking ahead, for the full fiscal year 2025, they're projecting approximately $6 billion in share buybacks. So it's a sustained, aggressive approach.
Okay, let's unpack this a bit. Stock buybacks are a powerful tool, aren't they? They send a strong signal from management, indicating deep confidence in the company's future prospects. By reducing the number of outstanding shares, they effectively increase earnings per share for the remaining shareholders.
Which can boost the stock value, yeah.
Right. But what are the strategic implications of such an aggressive program? Is there a risk they could be using capital for buybacks that might otherwise be invested in, say, growth or innovation?
That's always the critical question for any company with a robust buyback program, and it's a fair one. While it boosts EPS and can support the stock price, the decision to allocate capital this way reflects a belief, fundamentally, that their shares are undervalued and that this is the most efficient way to generate shareholder returns right now. It also signals that management sees strong organic growth pathways already funded or perhaps that the market isn't fully appreciating their current growth and profitability trajectory. Remember that Money Machine newsletter article we mentioned?
Yeah.
It explicitly stated, the new $15 B buyback authorization sets the stage for significant shareholder returns. It also highlighted that at the time, the company was trading at like 13.9x PE, appearing undervalued compared to peers, and even suggested a target price of $101 based on a 20x PE multiple.
Interesting context.
So these are strong indicators of the market's earlier view that the buyback was a smart move to unlock value, which we're now seeing play out. They're clearly saying, we believe in our future and we're willing to back it up with our balance sheet.
So strong financial performance, a bold strategic vision, clear commitment to shareholders. Let's zoom in now on the specific growth drivers powering this ambitious transformation. Okay, one of the fundamental pillars of this strategy is what PayPal is calling winning checkout. This is all about modernizing and optimizing that online experience, right?
Yeah.
In Q2, branded experiences TPV grew 8% currency neutral, and online branded checkout TPV grew 5% currency neutral. It seems they're making good progress. Over 60% of U.S. checkout transactions are now on their latest upgraded experience.
Which is a pretty fast rollout.
Yeah, and mid-teens percent globally. And they're clearly not stopping there, with a significant rollout expanding to the UK and Germany.
And this modern checkout isn't merely a cosmetic facelift for their payment button, It's a sophisticated engineering effort. It's designed to fundamentally improve the user experience at that critical point of purchase, enhance conversion rates for merchants.
Which is huge for merchants.
Absolutely.
Yeah.
And also to more effectively present integrated services like buy now, pay later right there in the flow.
Yeah.
They're aiming for higher conversion and selection rates by making the process faster, more intuitive, more personalized.
Makes sense.
It's worth noting, too, that while online branded checkout growth was consistent, it did face some tariff headwinds from platforms and merchants in Asia. Chris mentioned that without that pressure, the growth rate would have actually hit 6%.
Ugh. So global factors creeping in again.
Always.
Yeah.
It highlights the macroeconomic realities, even for a company as large as PayPal.
That 1 percentage point impact really illustrates the ripple effect of global trade policies, doesn't it? What do you think this expanded rollout in Europe, especially Germany, with its newer integrations, could mean for them in the coming quarters? And what exactly are they investing in over there?
Well, the expansion into high-value European markets like the UK and Germany is absolutely strategic. Germany, in particular, has seen significant investment. Those newer integrations promise to accelerate adoption significantly, which could have a substantial impact on international TPV growth, opening up new user bases.
Right.
And when we talk about investment, think about that highly visible Will Ferrell marketing campaign they launched in Germany for PayPal Everywhere.
Oh, yeah, I saw bits of that.
It wasn't just about brand recognition. It was about educating consumers on the new, seamless in-store and online experiences they can now expect. They're really pushing that connection. What's also forward-looking here is their focus on subscriptions as a key use case. By making recurring payments smoother, they're driving repeat branded checkout use. That shows an understanding of consistent, predictable revenue streams beyond just one-off purchases. Chris specifically highlighted that these upgraded experiences are driving the uplift we expected, so they're seeing measurable success from these investments.
That level of investment, both tech and marketing, suggests they see a huge payoff. But PayPal isn't just about traditional online checkout. They're aggressively expanding into flexible payment options, and buy now, pay later, BNPL is a huge part of that story.
Oh, absolutely huge. BNPL volume exploded, growing more than 20% in Q2. Monthly active accounts climbed an impressive 18%. But here's where it gets really interesting.
Okay.
The average order value, the AOV, when using BNPL, is over 80% higher than standard transactions.
80%.
Yeah, over 80% higher. That's not just a small bump. It's a significant lever for merchant growth. PayPal now offers BNPL in 9 global markets and has concrete plans to expand even further. This isn't just about offering a feature. It's about enabling higher value purchases for merchants.
More than 80% higher. That's genuinely staggering. It sounds like they're really carving out a unique and powerful niche in this increasingly crowded BNPL space. But what's their competitive edge against the pure play BNPL providers like Klarna or Afterpay? And how are they navigating the increasing regulatory scrutiny we're seeing around BNPL?
Good questions. Their competitive advantage largely stems from their unparalleled scale, ease of use, and trusted customer value.
Mhm.
Unlike newer BNPL players who often start from scratch, PayPal has this embedded, trusted relationship with hundreds of millions of consumers and millions of merchants.
Right. People already know and trust the brand.
Exactly. So for merchants, it means seamless integration, which translates to higher sales at lower costs. A key differentiator is the ability for merchants to feature BNPL messaging upstream on their product pages.
So before you even get to the checkout.
Right. Leveraging PayPal's trusted brand to build consumer confidence right from the product browsing stage. They gave an example. Ace Hardware saw a remarkable 35% year-over-year increase in total PayPal sales and a seven-fold increase in average order values after adopting this upstream messaging and a 0% APR promotion.
Wow, sevenfold.
Yeah, it provides clear, concrete evidence of BNPL's direct impact on merchant success. Regarding regulatory scrutiny, PayPal, as an established financial institution, operates under a different level of oversight than many newer fintechs.
Hmm.
They emphasize responsible lending, transparent terms, and leveraging their existing compliance frameworks. They're effectively integrating BNPL into their broader, regulated financial ecosystem. This provides a layer of consumer protection and trust that pure-play competitors often struggle to match quickly.
Okay, that makes sense. While BNPL is enhancing online options, PayPal is also strategically transforming its incredibly popular peer-to-peer app, Venmo, into a full-blown commerce platform. I remember when Venmo was just like how you split a dinner bill with friends.
Right. The pizza emoji days.
Exactly. It's incredible how much it's evolved.
It has come an astonishingly long way. Venmo delivered its highest revenue growth rate since 2023, over 20%, and its highest TPV growth rate in 3 years, at 12%.
That's significant growth.
Very. And what's more, Pay with Venmo TPV, specifically for commercial transactions, was up more than 45%, with monthly active accounts increasing approximately 25%. This isn't just users sending money to each other anymore. It's a clear, deliberate transition from primarily a social P2P tool to an everyday commerce platform where users are actively transacting with businesses.
That's truly incredible growth for an already established app. What specifically is driving this momentum beyond just splitting bills? And how are they managing to expand into commerce without, alienating the loyal P2P user base that made Venmo famous in the first place?
It's a smart balancing act. This robust momentum is driven by what PayPal terms deliberate product innovations and dynamic marketing campaigns. It's a two-pronged approach.
Okay.
On the product side, they're introducing features that seamlessly integrate commerce into the Venmo experience. On the marketing side, they're reaching key demographics in clever ways. A great example, their Big 12 and Big 10 college distribution deals.
Ah, the college sports partnership.
Exactly. These partnerships are groundbreaking. They enable college athletes to receive revenue share payments directly through PayPal or Venmo, immediately embedding the apps into the financial lives of a massive youth demographic.
Smart move.
Very smart. And more broadly, it extends the Venmo brand across college campuses, making it easy for students to use Venmo for spending at bookstores, ticketing, concessions, merchandise, you name it. They've also launched co-branded Venmo debit cards, making it a viable option for everyday spending. And to show its growing acceptance, top brands like Sephora, KFC, Taco Bell, Pizza Hut are now adding Pay with Venmo to their own apps. It just makes it easier for users to spend their Venmo balance wherever they shop. The key is making commerce optional and convenient within the existing P2P framework rather than forcing a jarring change. Right. Keep the core familiar, but add the options. Venmo's success is truly a microcosm of PayPal's broader omni-channel strategy, isn't it? Bringing digital payments fluidly into the physical world, and they're leaning heavily into physical debit cards as a crucial part of that expansion.
Absolutely. Debit card TPV across both PayPal and Venmo grew more than 60%.
60%.
Yeah, huge growth. Monthly active accounts up over 65%. They added approximately 2 million new PayPal and Venmo debit card users in the U.S. in Q2 alone.
2 million new card users in one quarter.
It's not just strong adoption. It's an accelerating pace of growth for their card products, directly competing with traditional bank cards now. So what's the strategic goal with this big push for cards? How does it play into their share of wallet strategy? Because it feels, I don't know, a bit traditional for a digital-first company like PayPal.
You're right. It feels traditional on the surface, but it's incredibly effective strategically. The strategy is explicitly designed to grow our share of wallet by offering card products that power every payment our customers make, both online and crucially in-store.
Okay, so bridging that gap.
Exactly. This creates a powerful flywheel effect. Customers who adopt these cards transact significantly more frequently, they choose PayPal online more often, and they deliver substantially higher average revenue per account.
How much higher?
They're talking about 6 times the transaction activity and a 3 times increase in average revenue per account for debit card users compared to non-card users.
Wow, okay, that's a big impact.
It really is. It's about becoming the default payment method in the customer's mind and in their physical wallet. They even launched a new physical card for PayPal Credit, which enables access to credit lines and promotional financing offers like 6 months interest-free on travel for in-store purchases. It extends the reach of their credit products offline.
And it seems like they're expanding this aggressively internationally too, right? Because truly, every payment has to mean global eventually.
Exactly. The PayPal Everywhere launch in Germany back in June is a prime example of this global omni-channel playbook in action. This initiative introduced the first ever PayPal contactless mobile NFC wallet on iOS and Android, making Tap to Pay with PayPal a reality in German stores.
Finally, getting that tap to pay widely.
Right. It also brought flexible Pay Later to Go for offline BNPL, and in-app cashback offers at over 2,000 stores. It creates a holistic in-store experience. This launch saw over 3 million NFC enrollments, with users transacting an average of 16 times per month just in Q2.
16 times a month. That's real usage.
Definitely shows engagement. And this highly successful pilot is now set to expand to the UK. It demonstrates a clear and effective playbook for global omni-channel growth, connecting their digital ecosystem firmly to the physical world.
This robust branded experience strategy sounds incredibly comprehensive. It touches on, well, pretty much every facet of consumer payments. But it's all complemented by improving foundational services for businesses, which brings us to the next section. How PayPal is truly empowering merchants, both big and small. Okay, let's talk about Braintree, their payment service provider, or PSP business. That's the side that handles payments for larger merchants, right?
Exactly, the behind-the-scenes engine for many big online retailers.
The PSP business, including Braintree, grew TPV by 2% in Q2, which PayPal highlighted as a stabilization from previous quarters. Braintree TPV itself was roughly flat in Q2, but it's now expected to return to growth in Q3. This marks what PayPal calls a positive inflection point.
And this turnaround is extremely significant. It really reflects a major strategic pivot they undertook. You might recall earlier strategic decisions, where PayPal chose to essentially reset our largest merchant relationships to price our services to the value we deliver.
Right, they talked about not just competing on price anymore.
Precisely. It was a conscious choice to prioritize profitability and the quality of the business over just raw transaction volume, even if it meant some short-term pressure on growth numbers. It's kind of like a retailer deciding to stop offering deep discounts just to move product and instead focus on selling items at a price that reflects their true value and the service wrapped around them. Now they're on the other side of that, as they put it, meaning they've managed to maintain those key enterprise customers, the major global brands, and are having more strategic conversations with them about value-added services rather than just haggling over basis points on price. The current focus is firmly on healthy quality growth and driving meaningful TM dollars improvement. It indicates a clear shift from pure volume to profitable volume in that segment.
So it sounds like they accepted some short-term pain for long-term strategic gain here. What's been absolutely key to this strategy's success in retaining those big merchant relationships and actually improving profitability, it couldn't have been easy.
No, definitely not. A critical element has been their significant investment in and scaling of their suite of value-added services, or VAS. These aren't just nice-to-have features. They're becoming real revenue drivers that are fundamentally transforming the margin profile of their PSP business.
Like what kind of services?
A prime example is Hyperwallet, their robust payout capability, which is growing rapidly. It's used by top travel platforms, mobility companies, social commerce platforms globally. Basically, anyone who needs to manage and distribute funds quickly and efficiently to a vast network of recipients, like gig workers or marketplace sellers. And it was also a key enabler for those Big 12 and Big 10 college deals we mentioned earlier. It allows rapid revenue share payments to student athletes directly into their PayPal or Venmo accounts. It really showcases its versatility for both huge enterprises and these newer emerging payout needs.
So it's about offering more than just basic payment processing.
Exactly. That's what allows them to justify higher prices, retain customers who need those advanced capabilities, and ultimately improve their margins in a very competitive space.
Okay, that makes sense for the big players.
Yeah.
But beyond these large enterprises and their complex payout needs, PayPal is also intensely focused on small and medium-sized businesses, the SMBs, right? Empowering them in what's obviously a very competitive landscape.
That's right. And they're seeing traction there too. Over half of SMB volume now flows through PayPal Complete Payments, or PPCP. That's a notable improvement in adoption for that integrated platform. And PPCP recently expanded into Singapore, extending its global reach.
And what does PTCP actually offer these SMBs?
It essentially offers SMBs easy, bundled access to PayPal's latest online branded checkout, plus new products like Fastlane, which we should talk about. It streamlines their operations and helps accelerate growth by improving conversion rates at checkout. And their deepening relationships with popular e-commerce platforms are crucial for broader merchant reach and simplifying adoption for smaller businesses that might not have big IT teams.
Right. Are there any specific examples of how they're empowering these smaller businesses to not just accept payments, but truly fuel their sales growth? And yeah, tell me more about this Fastlane. What exactly is it?
Certainly. Their expanded partnership with Wix is a prime example. This collaboration seamlessly integrates PayPal's full suite of payment tools directly into Wix payments. It effectively empowers SMBs on that huge platform to fuel sales growth by making it easier and offering more diverse ways for their customers to pay, whether it's traditional PayPal, BNPL, Venmo, you name it.
Okay. And Fastlane.
Fastlane is really interesting. Think of it as a streamlined, personalized guest checkout experience. It's for customers who might not have a PayPal account or maybe have a dormant one they haven't used in ages. It uses saved credentials securely, but without requiring a full PayPal login.
Ah, reducing friction for non-PayPal users.
Exactly. And merchants using Fastlane are seeing a remarkable 50% conversion uplift.
50%.
Yes. And it's even attracting dormant PayPal users back to the platform by making checkout incredibly frictionless. The next major milestone for Fastlane will be its multi-processor rollout in the coming quarters. That's expected to further boost adoption and utility, especially for slightly larger merchants who might be using multiple payment processors alongside PayPal. It's about universalizing that PayPal advantage of smooth checkout beyond just active PayPal users.
It sounds like they're strategically building out a really comprehensive ecosystem for businesses of all shapes and sizes. While these initiatives address current commerce needs, PayPal is also making some truly big and bold bets on the future, which leads us into some genuinely exciting, almost sci-fi level innovations they're working on. Okay, let's talk about PayPal World. This sounds absolutely fascinating, and it's expected to go live in the fall. The ambition here seems massive, creating a platform connecting 5 of the largest digital wallets globally. We're talking PayPal, Venmo, Mercado Pago, TenPay Global, and UPI from India.
That's the plan. 5 huge players right out of the gate. This initiative is genuinely designed to be a game changer, addressing a fundamental problem in global digital commerce today.
Which is?
Fragmentation. Digital wallets have become ubiquitous globally, right? Almost 3.5 billion people rely on them, accounting for something like 83% of digital payments worldwide. The number is projected to exceed 5 billion by 2026. But this ecosystem is incredibly fragmented. It creates friction for both consumers and businesses. For us as consumers, it means uncertainty about where our specific wallet will be accepted when we travel or shop internationally.
Yeah, juggling multiple apps.
Exactly. And for merchants, it means the headache of integrating numerous different technologies just to accept various wallets across different regions. PayPal World is designed to simplify this complexity. It enables seamless cross-border commerce and even peer-to-peer payments eventually. And crucially for the merchants, they maintain their branded checkout economics.
Meaning they don't lose money on these new transactions.
Right. They benefit from increased volume without sacrificing their existing revenue share from PayPal transactions. Alex Christ described it as a significant TAM expansion initiative, expanding their total addressable market with attractive economics due to the massively increased reach and simplified processing.
So it's about solving this huge fragmentation problem. But what does it mean for a merchant who already accepts PayPal today? Do they have to do anything new or complicated to tap into these billions of potential new customers from Mercado Pago or UPI? And what are the big technical hurdles in actually making this global interoperability work?
That's really the beauty of the design, at least as described.
Yeah.
For merchants who already accept PayPal, PayPal World will mean gaining access to billions of new customers through their existing integration.
No new work.
Supposedly, no new integration work required. This expands connections beyond PayPal's own say 400 million customers, to initially over 2 billion consumers worldwide through these partners. And that number is expected to grow as more partners hopefully join the World Network.
Mm.
The platform is also being purpose-built for the future, they say, compatible with dynamic payment buttons, stablecoins, which we'll get to, and even agentic shopping, that AI-driven commerce idea. Now, the technical hurdles are immense, no doubt. You're talking standardizing APIs across totally different systems, ensuring rock-solid security across diverse platforms, navigating different national payment rails and regulatory environments. It's complex. But the commitment from the CEOs of these partner wallets to make the experience frictionless, to make it feel native to the user, is key to its potential success. They want to directly address those historical challenges of interoperability. You shouldn't feel like you're using some clunky intermediary. You should feel like you're just using your wallet.
That's a massive leap forward for global commerce if they pull it off. Give us a really concrete, real-world example of how this would actually work in practice. Like for someone using, say, UPI in India shopping online.
Okay, perfect example. Imagine a UPI user in India finds a pair of sneakers they want to buy from an online store based in Germany that accepts PayPal. Today, that might be tricky. With PayPal World, they simply click the familiar PayPal button at checkout. But instead of being asked for a PayPal login they don't have, their familiar UPI button or interface will be presented right there for them to complete the transaction directly from their Indian wallet.
Ah, seamless.
Exactly. It's that simple, no new integration work for the German merchant, no new app needed for the Indian consumer. The platform will even eventually be able to intelligently identify the user and perhaps change the payment button dynamically to show their home wallet automatically.
Clever.
And the potential extends beyond online. They envisioned eventually being able to, say, scan a UPI QR code at a local market stall in India with your US-based Venmo wallet to make a purchase. The currency conversion would happen seamlessly in the background. Since the announcement, PayPal apparently received multiple inbound requests from other major global wallets wanting to join, which further validates the concept and signals maybe a true paradigm shift towards interoperability.
Okay, that's PayPal world. The future of commerce also seems to involve AI in increasingly sophisticated ways, and PayPal is clearly making some aggressive moves there, going beyond just, customer service chatbots.
Definitely. They are positioning themselves as an early mover in what's known as agentic AI in commerce. They actually launched the first remote managed commerce platform, or MCP, server specifically for commerce earlier this year. And they're actively partnering with major AI players like Perplexity, Anthropic, and Salesforce.
And agentic AI means?
Think of it as an AI assistant that can not only recommend products, but actually go out and buy them for you. Agentic AI is rapidly changing the commerce landscape by enabling consumers to purchase goods and services through these AI agents.
Okay, that's a step beyond just asking Alexa for the weather.
A big step. PayPal's crucial role here, as they see it, is to help merchants and developers meet this moment. They plan to leverage their differentiated KYC and KYB expertise. That's know your customer and know your business.
Right, identity verification and stuff.
Exactly. For identity verification, fraud prevention, regulatory compliance, all critical when an AI might be making purchases. This expertise, combined with its access to the largest ecosystem of payment-ready wallets with PayPal World, aims to strengthen their position as the go-to partner for agentic commerce. They want to provide the trusted payment rails for these new AI-driven interactions.
So it's about making sure PayPal is the trusted, secure payment layer for these potentially autonomous AI-driven transactions. What kind of experiences can we expect consumers to actually have? And what are the biggest challenges in getting users like you and me to really trust an AI agent with our purchasing power? That seems like a big hurdle.
Yeah, trust is paramount. These new experiences, as Alex Chris describes them, will allow customers to find the right products, check out directly within the AI client, track purchases, and much more. Imagine telling your AI assistant, find me the best noise-canceling headphones under $300, and it not only presents options, but potentially it completes the purchase for you securely through PayPal, right there within the AI chat interface.
Convenient, but yeah, the trust issue.
Absolutely. The biggest challenge for user trust will be transparency and control. Users need to understand how the AI is making decisions, have clear approval mechanisms before money changes hands, and feel completely confident that their payment information and preferences are absolutely secure. PayPal's long-standing reputation for security and its robust KYC/KYB processes are probably their biggest assets in trying to build that trust for this nascent but potentially revolutionary form of commerce. It's about making the AI smart and helpful, but still ultimately accountable to the human user.
AI isn't just about agentic commerce, it's also revolutionizing how merchants reach customers through advertising. And PayPal is looking to capitalize on its vast trove of data there, too.
This is a really interesting and potentially very high-margin new revenue stream for PayPal. In Q2, they launched off-site ads. This enables brands to reach millions of consumers across the open web. So, on other websites and apps through display and video ads, all powered by PayPal's rich data insights into actual purchasing behavior.
Okay, using purchase data for ad targeting?
Exactly. And building on this, they introduced storefront ads. This is a powerful new ad format that combines seamless in-ad checkout directly within the advertisement itself, combined with direct merchant integration, and of course PayPal's trusted payment capabilities.
That's a powerful combination, merging advertising reach with direct, trusted checkout right in the ad. What's the strategic play here? How does PayPal's ad offering differentiate itself from the established giants like Google or Meta, who also have immense amounts of data?
The strategic play is to leverage PayPal's unique first-party data on actual purchasing behavior. While Google and Meta have vast data on browsing, searching, and social interactions, PayPal has direct insight into who buys what, where, and when.
Right, the transaction itself.
Yes, exactly. This initiative aims to create more personalized shopping experiences by allowing merchants to reach the right customers more effectively, not just based on their inferred interest, but on their proven purchase history. The differentiation of storefront ads is critical. It lies in offering that in-ad checkout combined directly with PayPal's trusted payment capabilities. This drastically reduces friction from seeing an ad to actually making a purchase, and it builds on the trust consumers already place in PayPal for handling money securely.
Yeah, fewer clicks, more conversions potentially.
That's the idea. By embedding checkout directly into the ad, they can potentially achieve much higher conversion rates than traditional ads that just click through to a website. They've already started expanding these ad products internationally, with PayPal ads now live in Germany and the UK. It signals a significant new, potentially high-margin revenue stream leveraging PayPal's vast user data in a powerful, transaction-focused way. They're effectively saying to merchants, we know who actually buys your type of product. Let us help you reach them more directly and make it super easy for them to buy right now.
Okay, very interesting. Finally, in this future-looking section, PayPal is pushing the boundaries of traditional finance with its stablecoin and crypto initiatives. This feels like a very significant move for a company of PayPal stature, stepping directly into the future of digital assets.
It is significant, and they see their stablecoin, PYUSD, as absolutely central to addressing some long-standing pain points, particularly the high fees and the slow speed of cross-border money transfers.
The remittance market, for instance.
Exactly. PYUSD is designed to deliver a stable, reliable, and cost-effective alternative to conventional systems, enabling businesses and individuals to transact with greater confidence and agility globally, especially for international remittances or B2B payments where speed and cost matter a lot. In Q2, they added the ability to earn rewards for holding PYUSD and significantly expanded its availability on additional blockchains like Stellar and Arbitrum, increasing its accessibility and utility across the crypto ecosystem. This is about solving real-world problems for customers, starting with cross-border transactions, but with the ultimate aim of mainstream consumer and merchant use cases down the road.
And how does this stablecoin, PYUSD, specifically connect back to their broader PayPal World platform vision? Because that interoperability feels like a key piece of the puzzle.
Yeah, they explicitly stated PYUSD will be a major enabler of the PayPal World platform. Imagine being able to send PYUSD almost instantly from your PayPal wallet to a friend's Mercado Pago wallet in another country, or paying an international merchant who accepts PayPal World, all using a stablecoin that minimizes currency conversion fees and speeds up settlement times dramatically compared to traditional rails.
Okay, so it greases the wheels for PayPal World.
Precisely. Furthermore, they announced Pay with Crypto just recently on July 28, 2025. This will enable instant crypto to stablecoin or fiat currency conversion for over 100 different cryptocurrencies at the point of sale.
Wow, over 100 cryptos.
Yeah. This initiative taps into a massive global base of potentially 650 million crypto users, allowing them to instantly spend their diverse crypto holdings wherever PayPal is accepted, crucially, without the merchant needing to accept or handle volatile crypto directly.
Big benefit for merchants there.
Huge. This is also viewed internally as a significant TAM expansion with attractive economics, because the underlying expenses associated with processing crypto or stablecoin-based transactions can be significantly lower compared to traditional card payment rails with their interchange fees and network costs. As Alex Chris put it, a big part of the future of commerce will be on-chain, and PYUSD will help power that journey. They're also strategically collaborating with major players like Coinbase, Fiserv, and MasterCard to expand PYUSD's prominence and reach, clearly aiming for mass adoption over time.
These innovations are certainly exciting, painting a picture of a future with highly integrated, AI-driven, and potentially crypto-powered commerce. But let's anchor back to the financial reality and what PayPal actually expects for the rest of this year. All right, let's look at the detailed financial metrics for Q2 2025, because these numbers really tell the story of their current operational health, right?
Yep, the proof is in the pudding, as they say.
When it comes to accounts and engagement, total active accounts grew a modest 2% to 438 million. Monthly active accounts, or MAA, also saw a 2% increase, reaching 226 million. Transactions per active account, excluding PSP, grew 4%.
Okay, so what this collection of metrics tells us is that while the overall number of accounts isn't growing explosively right now, the existing user base is actively engaging more with PayPal's core and new branded offerings. That growth in transactions per active account outside of the big Braintree PSP business is a key indicator.
Showing deeper engagement.
Exactly. Deeper user engagement with things like Venmo, the branded checkout improvements, the debit cards, BNPL, and other consumer-facing products. However, it is worth noting that the total transaction count across the whole platform was down 5%.
Oh, okay. Why was that?
As we discussed earlier, that's largely attributed to Braintree's strategic price-to-value actions in the PSP segment, consciously sacrificing some lower-margin transaction volume to focus on higher profitability there.
Gotcha. Makes sense in context.
Moving to the revenue mix, transaction revenue grew 4% on a currency-neutral basis. But the other value-added services, or OVAS, revenue grew a significant 16%.
16%? What's driving that?
Primarily driven by strong performance in consumer and merchant credit products. This really highlights the ongoing diversification of the revenue streams beyond just core transaction fees, which is generally a healthy sign for long-term stability and resilience.
And what about their transaction margin, the TMO we talked about earlier? How did that perform specifically in Q2?
So transaction margin dollars, TMAO, grew 7%. And TMO, excluding that interest on customer balances, grew 8%, reinforcing that focus on profitable growth we started with.
Okay.
Now, this did include a roughly 1.5 percentage point one-time benefit from a key payment partner relationship, which helped a bit. However, that benefit was actually more than offset by slightly higher transaction losses in the quarter.
Transaction losses went up. Is that a concern?
Well, the transaction loss rate, or TL rate, did increase by 3 basis points to 0.09% in Q2. PayPal attributes this increase to two main factors. First, a normalization in loss rates following last year's unusually strong performance. Basically, losses were exceptionally low last year, and now they're returning to more typical historical levels.
Okay, so a reversion to the mean, sort of.
Kind of. And second, there was some impact from new product introductions. Think about it. When you launch new products, especially things involving credit or new types of card usage, like the debit card scaling up, there's often an initial, slightly higher loss rate as you scale and optimize the risk models for those new flows.
Right, learning curve.
Exactly. PayPal expects the full-year run rate for transaction losses to be around 8 basis points, or 0.08%. This suggests management feels they have a firm handle on it and sees this Q2 bump as a controlled expected part of rolling out and scaling these new growth initiatives.
That makes sense. You have to test the waters with new products. How is their credit portfolio looking overall, particularly with their stated balance sheet light model? Are they taking on a lot more risk there?
On the credit portfolio front, net loan receivables grew 7% sequentially from Q1 to $6.9 billion. Importantly, they're seeing improvement in charge-offs and noted low stable delinquency rates, which is a positive sign for the health of their lending book right now.
Good.
The balance sheet light model is key here. It means they aim to originate the loans, offer them to consumers and merchants, but then partner with third parties like banks or investment funds to hold a significant portion of those loans off PayPal's own balance sheet.
So they don't carry all the risk or capital requirement?
Precisely. It helps them manage risk and capital requirements much more efficiently. They have concrete plans to externalize another part of the portfolio later this year, which further de-risks their position while still allowing them to offer these valuable credit products that drive engagement and revenue.
And how about operating expenses? Are they keeping a lid on costs while still investing so heavily in this ambitious transformation we've been discussing? Seems like a tough balance.
It is. Non-transaction-related OpEx increased a modest 2%, which does reflect continued cost discipline and a focus on efficiency across the organization. But this discipline is balanced with strategic reinvestment in product development, technology, and marketing to fuel that long-term vision. They also reported restructuring costs of $92 million in Q2. These were primarily related to workforce actions they took earlier in the year and also some key tech transformation initiatives, things like re-engineering their core infrastructure, exiting expensive legacy data centers, and migrating more services to the cloud, all fundamental steps to build a more agile, scalable, and ultimately cost-efficient platform for the future. These are really considered investments in future efficiency, not just current expenses.
Okay. These Q2 results seem to underpin their confidence in the outlook for the rest of 2025. They even raised their full-year guidance, which feels like a strong signal in what's still a somewhat uncertain economic climate globally.
It is indeed a strong signal. Following a strong first-half performance, PayPal raised its full-year guidance for both TMR and non-GAAP EPS.
What are the new numbers?
For the full fiscal year 2025, TMR is now expected to be between $15.35 billion and $15.5 billion. That represents 5–6% growth, or an even better 6–7% growth if you exclude the impact of interest on customer balances. That's an impressive increase from prior guidance.
Yeah.
Non-GAAP EPS is now expected between $5.15 and $5.30 per share, indicating a healthy 11–14% growth year over year. And importantly, they are reiterating their guidance of $6 billion to $7 billion in free cash flow for the year and approximately $6 billion in share buybacks. It demonstrates a consistent commitment to both strong operational performance and those significant shareholder returns we talked about. This raised guidance shows clear, sustained confidence in their strategy, even acknowledging potential broader market fluctuations.
That's definitely a strong vote of confidence from management. What are they specifically expecting for the immediate next quarter, Q3, and what are the specific factors they're keeping an eye on?
For Q3 2025, they expect currency-neutral revenue growth to be at the lower end of mid-single digits, so around 4%. TMAOs are projected to be between $3.76 billion and $3.82 billion, which translates to about 4% growth, or closer to 6% if you exclude interest on customer balances. Non-GAAP EPS is expected in the range of $1.18 to $1.22, which is roughly in line with the prior year at the midpoint.
Okay.
Jamie Miller, their CFO, specifically noted that the low end of their full-year guide could absorb up to a couple of points of deceleration in e-commerce spending should that occur.
So they built in some cushion for a slowdown.
Exactly. It shows a pragmatic, risk-aware approach to potential macroeconomic uncertainties. They also explicitly called out anticipating approximately $125 million in interest rate headwinds spread across Q3 and Q4 combined that represents about a 2-point negative impact on TMW growth in the back half. And they'll face tougher credit growth comparisons in the second half just because prior year growth was so strong. This will be balanced, though, by planned higher OpEx growth in Q3 specifically, as they lean into critical tech investments and some strategic marketing shifts to support product launches. So it's shaping up to be a period of calculated investment for future returns in the second half.
Okay. So despite all this momentum and confidence, what are the inherent risks and potential bumps in the road as they execute this truly ambitious, multifaceted plan? Because no strategy is without its challenges, right?
You're absolutely right. There are always inherent risks. The main ones internally would include a potential reversal in active account growth if users somehow become less engaged or start leaving the platform, or a significant unexpected drop in free cash flow or operating margins.
And externally?
Externally, macroeconomic uncertainty remains a big one. Persistent tariffs, other kinds of trading friction. These could impact global economic activity, overall consumer spending levels, and even supply chains, all of which directly affect PayPal's transaction volumes. For example, that tariff impact they saw in Q2, which trimmed about 1% off branded checkout TPV growth. That's a tangible example of these external factors at play.
Yeah.
PayPal management stated they're actively monitoring the market for shifts in retail spending and macro policy, demonstrating a cautious and pragmatic approach. And of course, there's the constant risk from intense competition in the payment space. New fintechs pop up, established players keep innovating.
Yeah.
They can't stand still.
Those are certainly real external factors that any global company has to contend with. How do they see certain specific regulatory changes impacting them? Like the evolving landscape of open banking initiatives we hear about in different regions, does that pose a threat?
It's a good question. Alex Chris specifically commented on open banking changes during the call, stating they view them as immaterial to PayPal at this stage.
Oh, interesting. Immaterial.
Yeah. That provides a somewhat reassuring detail, suggesting that at least some regulatory shifts, which might significantly impact traditional banks or other financial institutions, are not currently expected to pose significant challenges to PayPal's core business model or its strategic transformation plans. This likely speaks to their existing infrastructure, their platform approach, and maybe their already broad capabilities. But these risks overall aren't just for PayPal. They reflect broader trends in the global economy that impact everyone, from us as consumers to small businesses everywhere. It underscores the interconnectedness of our financial world. But PayPal certainly seems to be building its strategy with these broader trends and potential risks firmly in mind. #outro.
Wow, what an incredible deep dive that was. We've truly unpacked PayPal's Q2 2025 results, and it reveals a company that is not just evolving, but undergoing a truly exciting and, importantly, profitable transformation.
Yeah, it's quite a story unfolding.
From strengthening its core branded experiences with that modern checkout, a booming buy now, pay later segment, and a rapidly evolving Venmo moving beyond just P2P.
To expanding its reach into fluid omni-channel payments, connecting the digital and physical wallets through debit cards and initiatives like PayPal Everywhere.
And we've seen how they're driving PSP profitability through value-added services and empowering SMBs with tools like PPCP and Fastlane.
All while making these really bold, forward-looking bets on the future with monumental projects like PayPal World, the promise and potential pitfalls of agentic AI and commerce, those new personalized ad platforms leveraging their unique data.
And their stablecoin, PYUSD, aiming to power the next generation of faster, cheaper, potentially on-chain transactions. The pace of innovation they're attempting is clearly accelerating. They're really trying to build a comprehensive, interconnected ecosystem for the future of money and commerce.
PayPal is actively trying to shape a future where the lines between online, offline, and even AI-driven shopping experiences completely blur, making global commerce not just seamless, but truly dynamic and personal. But here's a thought to leave you with. As our digital wallets become increasingly interconnected and integral to literally every purchase we make, what new opportunities and perhaps what new subtle considerations will emerge for you, the consumer? How will you manage your money, protect your digital identity, and make informed decisions about where and how you choose to spend it in this rapidly evolving landscape? It's a powerful question, isn't it? Because the future of commerce isn't just about how we pay for things. It's about the very fabric of our financial lives and how we navigate an increasingly complex digitized world. How much control do you really retain when an AI might be suggesting or even making purchases? How do you ensure your data is used responsibly as advertising gets hyper-personalized based on your spending? These are the underlying questions this evolution of platforms like PayPal really raises for all of us.
Definitely something to think about. Keep an eye on how these innovations unfold because the way you interact with commerce tomorrow is truly being built today.